Good morning. Thank you for joining us at TradeWinds for a end-of-year video. 2025 has been a year full of ups and downs, and I am joined this morning by one of our financial advisors here at TradeWinds, Bowie. We have a handful of things we want to throw your way, both as this year comes to an end and we reflect on both the highs and the not-so-highs of 2025, but also some practical steps you can take in 2026 to continue to keep yourself on the right track. And of course, at TradeWinds, we're always here to help you do that as well. Good morning, Jeb. Thanks for joining.
Yeah, man. Happy to be here.
2025, as I alluded to, had quite a bit of highs and lows. We know what the story roughly looks like, although we have a couple weeks left in the year. What stands out to you as you look over the last year or so?
Yeah, it's easy to have a bit of a short-term memory, I think. I mean, the world was falling in the spring.
Yes, it was.
We had a new president, maybe even before that, going all the way back. We had a new president elected at the end of last year.
Right.
He came in, started just kind of throwing his weight around and doing a bunch of different things, much to some people's delight and chagrin, depending on who you are. And the markets reacted, especially with the announcement of tariffs. Tariffs probably the word of 2025.
Right. Tariffs and AI, I think.
Tariffs and AI, exactly. So tariffs, one of the main themes. And then even, I think it was yesterday, I saw an article that was, so tariffs, now what? Basically, nothing happened to the downside or the upside with them was the argument or the thought process. So again, the year started off pretty choppy and the sky was falling, and then we've just seen a pretty steady increase, at least in stock prices, to end the year, and it's been a very positive year. So a lot going on.
There is a lot going on. You just alluded to the tail end of your comments. We've seen stock prices appreciate. We haven't exactly seen the general feeling of Main Street doing the same thing. We've seen Wall Street enjoy this year, although, as you alluded to, the spring, March, April timeline was pretty rough for the Wall Streeters. But Main Street still seems to be not super optimistic about the future, and 2025 maybe didn't treat Main Street nearly as well as it treated Wall Street.
Yeah.
Do you have a thought or sense on that?
No, I think that's right. I think especially for certain kind of segments of the population and ages, us being younger relatively, I think a lot of younger people didn't have as great of a year, where homes continue to be expensive, and a lot of my friends and contemporaries are trying to purchase their first home, or the job market wasn't great. A lot of people, and it continues to be a bit of a challenge. A lot of people have had the open to work on their LinkedIn for a significant amount of time, people who are looking to change. It's been a bit of a struggle there. So to your point, stocks have done well this year, but I think the sentiment of as a whole hasn't been amazing. And even retirees who have big stock portfolios and have seen their balances increase are still a little wary of, okay, when is the shoe going to drop?
Yeah. No, I know you and I did an episode earlier in the year attempting to answer or provide context around stocks continue to keep going up and hitting new highs. When is it going to come down? Or it can only go up for so much. It's got to come down. If you're interested as a viewer to rewind and see what Jeb and I had to say earlier this year, I invite you to do so. This morning's going to take a little bit of a different spin, right? We generally know what 2025 has given us so far. Again, knock on wood. We wanted to present to you, the viewer, today some pragmatic steps. What are practical things that you can consider doing to both protect yourself and to put yourself in a position to take advantage of whatever life may throw your way before putting your hands on your portfolio? So we oftentimes hear this sentiment of just stay the course, tune the noise out, disregard the headlines. And while I think those are all really good things to consider, man, it can be really, really tough to do that. I wanted to start with, I handed you a couple of quotes earlier this year as we set some proper context. we hear from our business leaders, our main bankers, some really famous people on Wall Street, perhaps even other advisors or other talking heads, media-wise, about how when is the next shoe going to drop, or making short-term predictions that 9 times out of 10 are laughably wrong, but these people aren't really held accountable for their opinions one way or another. A couple of pointers or a couple of things to point out on that page. I mean, we have Larry Fink for BlackRock speaking of a recession or expected downturn earlier in the year. Jamie Dimon with JP Morgan, probably one of the most influential people in the just financial world at large. Basically saying the same thing, right? Parroting, we're expecting stock prices to really have a lot of stress, or there's a lot of uncertainty. When you read a handful of those quotes, what pops into your mind, and what's your general approach to those kinds of things?
I guess what pops into my mind is obviously it's pretty hard. There's a lot of quotes here about short-term outlooks, and it's about to be choppy, it's about to be challenging. And time is relative, right? It can be hard to say what the timeline is, but these seem to be, this next quarter is going to be a problem, is kind of the underlying sentiment. And again, to your point of Jamie Dimon, he kind of was alarmist in May. He was alarmist in June.
Right.
And we know what markets have done since then. So it's not to say that this will never come true.
Sure. Agreed.
But I told a client recently that I do think more money is lost sitting on the sidelines preparing for the next drop than is lost when the actual drops happen. Because even going back to a previous career, and I was working at a bigger box, and I was talking to people all the time on the phone who I would see their portfolios, and they would have a bunch of money in cash that had been there for years because they were waiting on the next shoe to drop. And it, of course, hasn't yet. And they're going to be geniuses when it does. But the problem is they've missed out on 20+% for years in a row.
Right.
So it's the question ultimately to me is kind of at what cost? And I think to answer your question of, okay, how do I approach this, is even the smartest people in the room really struggle to understand, well, when is it going to come to fruition? And it's even harder to say, is it worth sitting in cash right now to try to avoid whatever is to come? Versus staying invested, because as we know, if you've stayed invested over the last handful of years, you've been rewarded.
Yes.
And if you've been sitting on the sidelines, then you obviously haven't been as rewarded. So it's a really tough question to answer as far as, well, what are you supposed to do at any given time with your portfolio, which is, again, to finally put a period on the question you asked me, was I tend not to do too much with portfolios because it's really hard to anticipate when is that other shoe going to drop, as we see through these quotes.
And by doing much with portfolios, I'm assuming you're talking about frequently changing them, or pushing investments toward cash, or going all in, or, putting your fingerprints unnecessarily on the portfolio. I know how diligent you are in making those decisions, but not reactionary or trying to be overly proactive and trying to see what the next chapter or the next quarter is going to look like. Is that what you mean?
Correct. I think specifically in the context of these is every time I read a Jamie Dimon quote, I don't go and say, okay, we're going all to one thing or another.
I see.
The entire investment philosophy is shifting like that. It's almost like a cruise ship or a tanker. It's a slow turn. It's not a jet ski where we're just flipping back and forth.
Well said. Yeah, the quote of don't just do something, stand there.
Yeah.
A little bit opposite than how we normally hear that phrase, but it can be really sage wisdom when it comes to portfolio management. Speaking of sage wisdom, let's talk about things that we can do to prepare ourselves even before we get in the context of making a portfolio change, whether it's a reasonable change, maybe rebalancing back to a comfort level of risk and reward that you fully understand and you have good context around what you're doing. Let's talk about all the things we can do even before that. And I think still positions you as an investor, but of course you just as a person with bills and savings or withdrawals. What are a couple things that pop into your mind as you're thinking about being proactive really before we even get to the portfolio conversation?
I want to hammer on that point real quick. I think the underlying assumption with some of these quotes or just the public at large, when you think about your finances and your financial advisor, would be the first thing that I need to do is go change where I'm invested. That when I turn on the news and hear a thing or read an article, I need to go and change something with my portfolio. And I think that's what I was getting at earlier.
I see.
That we're trying to avoid. And your question is, okay, well, what are the things that we should be making sure we've got nailed first before we're losing a bunch of sleep over the portfolio and the investments specifically? Is that does that track with the way you're thinking about this topic?
Totally. So I think we're flipping the script in a way of that's an initial inclination, right? We see that in Hollywood and maybe family members, other media outlets, like call your guy or gal immediately or log into your self-directed account and sell everything when you think something bad is about to happen. We're challenging that idea is instead of that being first resort, being really last resort. When I think of a handful of things we can do proactively, it's the first chapter in every personal finance book. And everyone glosses over it. But it's establishing that emergency fund. It's boring to most people and you kind of flip right through it, but I want to intentionally slow down and really unpack really the richness that comes from that conversation. How much do I keep? How do I define that number? Where do I keep my emergency fund? And for what is it appropriate for me to use it for? Just as I shotgun blast handful of those questions, what pops out to you?
That question of how much is a rich one. And this is where it gets to be a bit more art than science at times.
Agreed.
The scientific answer, the textbook answer is the classic 3 to 6 months of your monthly expenses. But the art of it is, okay, well, what is your stage in life? For someone who just graduated college, I think it's an excellent goal to get to that 3 to 6 months, but I'm not shaking in my boots if I look at their finances and they don't have the 3 to 6 months already saved, right? Like that's a tough stage in life potentially to save money. And I don't expect them to have that ready to go. At the same time, if you are in your mid 40s and you've got kids who are counting on you and maybe your job isn't terribly secure, and I would want you to have 6 months plus of finances ready, of emergency fund ready to go. Another kind of key piece of defining that figure would be maybe if you're in your working years, are you a dual income household or a single income household?
Well said.
If you're dual income and you lose one of those, okay, you may be able to scrap it together. If you're single income and that one income is lost, you're rocked. Exactly right. So there's a lot more to the art of defining that number. And then the final piece of it, I would say, is there is a risk tolerance reflected in that number. How willing – some people are just going to sleep better at night having 6 months, a year worth of their expenses covered in cash. That's not to say that that's the right thing for everyone. But I think the main idea would be – what is a number that allows you to be comfortable and to act with confidence in the other areas of your finances? I think that's what we're getting at is if you don't have enough in your emergency fund, well, then you can't afford to take risks with other parts of your portfolio, with your career. Mm-hmm. You can't afford to take a pay cut for something that may be a huge win for you in the long term because you're married to that paycheck. But if you've got enough, you can afford to take some risks in your career and with your portfolio. Not unhealthy risk, compensated risk.
Right.
But you just have a lot more flexibility when that emergency fund is well defined. There's a lot more to the emergency fund conversation. What sticks out to you?
No, that's an excellent response. Those are a handful of the things that pop into my mind as well. To add, I love that. Really the contrast between an emergency fund allowing you to take risk. I think that's why it maybe isn't the most interesting thing in the world to a lot of people. You're thinking about boring cash. We know it's not going to grow. We know the banks don't really pay us that great of a rate. But in an indirect way, that allows you, that really gives yourself permission to take prudent risk, right? Without a properly funded emergency fund, it's probably not a great idea to buy risky assets that can lose substantial portions in relatively short periods of time. Like maybe Larry Fink and Jamie Dimon would have you predict or believe may happen. A part of the art aspect of it as well, I will ask people to envision a really, really bad month, a realistic one, but what if a lot of those dominoes just got hit in 1 month? I'm thinking a home repair that isn't covered by insurance.
Yeah.
I'm thinking of a major car component going out or having a lot of mechanical cost. Of course, losing income would be a substantial one. Yeah. Of course, a healthcare event where you are out of work, if you don't have things like disability coverages or another spouse to help fill the gap. So I think of how hard could life punch you in the face and how much would that cost to roughly give us an idea of that paired with 3 to 6 months or that healthy number.
Yeah.
That gives, again, yourself permission, I think is a really good way to put it, to take risk elsewhere.
Yeah.
It's necessary to take risk, but being careful with how we're aligning our resources to support your financial plan, I think that's the overall idea.
Yeah, I think that's well said. And then again, I think that number varies widely depending on stage in life. I think we keep saying this 3 to 6 month rule of thumb. I think that's especially true of mid-career professionals who have this expectation of income that may be different for a retiree who no longer has income coming in, maybe outside of Social Security and a small pension.
Right.
I think depending on what your Social Security and pension, these are all the factors that go into defining that number. Right. If you have a massive Social Security and pension benefit that more or less helps you meet all your needs, maybe it's not as important for you to have a bunch of money sitting in cash that has an opportunity cost, not to get too jargony, but there is a cost to having your money sitting in cash that could be potentially appreciating at a better rate.
Totally.
But on the flip side of that would be a retiree who is mostly living off of their portfolio. It could make sense for them to have a significant portion of that in cash so that they know for a fact, maybe it's a year, that I can meet my needs for a year no matter kind of what comes, no matter what challenges life were to throw at me. So it's definitely based on your personal situation. But what I would say is no matter your stage of life, you need to have that in place. And that's one of the starting points to kind of put a hammer to the nail in terms of before we even start talking about how do we mess with your portfolio. Right. Are you holding an appropriate amount of cash? And have you even defined what that amount is?
Sure. Warren Buffett has a wonderful quote that I'm going to butcher, but you'll get the idea. Cash is like oxygen. When you don't have it, it's the only thing you can think about. So to our viewers here, what is that amount of cash, leaning more into the art side of things? What's that amount of cash that helps you take a deep breath, even if something terrible or by definition unexpected, an emergency happens? What is that rough amount that pops out to you? To talk through a handful of other things, we keep mentioning that either 3 to 6 months or a year. it's impossible to know what our 3 to 6 months of expenses look like if we don't know how much we're actually spending. This is really difficult as well. The vast majority, even really well-tuned investors and those who have a solid understanding of where their money is, really struggle to answer that question, how much do I spend? Are there any tips or tricks or best practices you can think of when attempting to answer that question? And in full disclosure, I have an idea, but I wouldn't be able to tell you exactly within probably a couple $100 of what exactly I would expect to spend in a month, especially being December, and some of the travel and all the fun stuff that comes with that. Any ideas on that front?
It depends on all things in finance. It depends. It's fun. I mean, you can look that question up on Google or go type it into ChatGPT, and it'll give you all these different rules of thumb, the 50, 30, 20 spending, and or you should go download this app, or you should track your expenses this way, or whatever.
Right.
I think one of the things I always come back to, and that is underlying every single rule, is how much are you saving? Or if you're retired, how much are you withdrawing? More so as a percentage. So what do I mean by that? I guess thinking about, let's start with accumulators, people who are still working, aren't retired. An accumulator, it may be hard to know how much you're spending, but if you know how much you're saving, and you know that you're not taking on any additional credit card debt or anything like that, well, then you know that you're spending whatever your salary is, minus the amount that you're saving, and there's taxes and stuff like that in there as well.
Right.
But you kind of back into that number, and I guess the way I think about it with clients is as long as you are being diligent about your saving, maybe it's via a 401k, and it's just it's kind of set it and forget it. They take out 10 to 15% every month, and you never even see it. And if your bank account stays at about the same level, well, then now I know about how much you're spending. And again, as long as you're not taking on any debts or anything crazy like that, then I'm comfortable with that person spending, even though we don't know it down to the dollar. And then to take that to a retiree, I would say, okay, we know that maybe you can take about, on average, 4 to 5% of your portfolio out without jeopardizing it too much. If you were taking out 10% a year, it's unsustainable.
Right.
If you're only taking out 1 to 2% a year, then
see it grow.
You're leaving a lot of money that you could be spending to the enjoyment of yourself or those around you on the table. Okay, so defining what that number is and being aware of what you're taking out, I think, becomes the game as a retiree.
Fair.
So I don't really care if it's you're spending 25 grand a year or 100 grand a year, as long as it's a sustainable withdrawal from what you have coming in via your Social Security and your portfolio. So again, I think pre-retirement, it's what are you saving? Post-retirement, it's what is the percentage that you're taking out, or otherwise known as your withdrawal rate. It all kind of comes back to that. What are your thoughts when it comes to defining those spending or budgeting?
Yeah, and that B word is a cuss word,
yeah,
right?
Budgeting,
is, everyone
absolutely.
it's not the most exhilarating topic in the world. I think a great place for you to start, and the way that I look at it, is really defining those big ticket expenses of yours. So not getting tripped up on the coffee or the snack at the gas station or something that's relatively immaterial for most people, but really locking in on, okay, here's what my mortgage actually is. Here's how much I pay for my car or student loan, or generally my credit card runs about this, or my power, my water. Like, what are those recurring expenses that you're going to have really whether you like it or not? I mainly define those as fixed. Fixed being a more liberal interpretation of the word. I define like my water bill and my power bill as fixed. Not that they're the same exact cost every single month, but within reason, I know what they're going to be, and they're certainly going to be, I'm going to be charged those expenses. I don't really have a ton of control over really jacking that up or reducing that down versus variable expenses, maybe a more truer definition. I do have more control over it, how much we go out to eat or travel or spend on entertainment. I can cut back on entertainment much more easily than I can cut back on a mortgage payment without there being some severe ramifications. If you have a really good handle over those fixed expenses, really the tug on your cash flow, I think that's a really good place to start. That's not to overlook the small things because those add up pretty quickly as well. But instead of trying to eat the elephant all in one big bite, just a little bit at a time, better understanding may be a really good place to start, especially if the B word scares you or isn't something that makes you excited, and you're in good company if that's the case.
Let me add one final thing to that, which is, again, I think there's levels to how do you think about your money. At a 101 level, the reason I talk about savings and withdrawals is it's basically impossible to either save towards a successful retirement or to have a successful retirement if you're not either sustainably saving or sustainably withdrawing. That's like level 101. If you're not doing those things right, we don't have a chance. So going back to the start of this conversation of what do we need to define before we start tinkering in our portfolio? Well, you don't have a chance no matter what the markets do if you're not doing those things correctly.
Well said.
I like your thought of, okay, well, let's dive one level deeper. Do you have an awareness of what you're spending? And then if you want to go to maybe level 300, 400 classes, I would say it's giving your dollars a job. And that can be a tough pursuit. That's not overnight. It's not necessarily easy, but maybe I think that's easier to swallow than budgeting, that cuss word that you said earlier. But like giving your dollars a job, I like the idea of when you think about the dollars you have coming in through work or in retirement through Social Security and otherwise, starting to define, okay, this is what I want you to do. I want you to be towards vacation. I want you to be towards paying my mortgage. I want you to be towards this and that. And ultimately, the reason I would say that's the most advanced level is that's when you start to be able to say, man, am I misallocating these dollars? Have I been giving some of these dollars jobs that I don't even value? And that's where you can start to say, okay, I feel like I'm paycheck to paycheck. Okay, but maybe I value a vacation with my family a lot more than, I don't know, maybe the gym membership that I haven't used in 6 months. Those types of things. So when you are able to define those jobs, I'm not saying that's for everyone and that has to be done tomorrow, but that's when, especially if cash flow feels like a big challenge to you, if you can think about it less as a budget that is constricting, but like I'm the CEO who is giving my dollar bill employees jobs within my life, that's when clients really start to have success.
There you go. No, well said. It is so tough to do that in the consumerism society that we live in, not to place the blame solely on our environment, but the marketing is only getting better. The ability to get things without fully having to pay for it up front. The whole buy now, pay later idea, and just credit cards or short-term debt instruments in general make that incredibly easy to meet the immediate need, but not positioning yourself too well for long term. Let's talk through two more things as we come to a close. Something I think a lot of folks may overlook is understanding your insurance coverage. Right, that can be a really big risk that's apparent in your overall financial picture, even if something happens income related, job related. Heaven forbid you're not able to work, or if you prematurely leave this physical earth, which happens all the time for families. So as we think about that in concert to crazy things happening that lead to putting our hands on the portfolio, the insurance component is one that maybe doesn't come to mind immediately, but is still critical. Your thoughts and considerations there?
So much of this comes down to risk. I feel like we've danced around that word a little bit. And people are very familiar with that when they think about their investments. That's the reason that they want to tinker, is to mess with risk, which I think we're going to get to in a second as well on a different topic. But with insurance specifically, to your point of leaving this physical earth, think about a situation where something happens to you, or if you're married to your spouse. What is the world that is left behind if you were to prematurely pass away? And it's not a fun thought experiment, but a necessary one.
Sure.
And for some people, maybe insurance coverage isn't even necessary, at least not significant life insurance.
Right.
So if I don't have any debts and I don't have anyone depending on me, if something were to happen to you, yes, the world would mourn, but you wouldn't necessarily, no one would be left in financial dire straits because of your passing.
Right.
On the flip side of that, if you're, again, this mid-career professional idea with 3 young kids and maybe even a spouse who stays at home and you're the only one working, and you've got a mortgage, you've got debts, you plan to send your kids to college.
Oof.
If something were to happen to you, your spouse would be left without a job, without an income, and kids to take care of. Well, there's significant risk in your human capital disappearing. If something happened to you, problems would ensue, obviously.
Right.
And I think before we get into tinkering with our portfolios, we need to kind of take a look in the mirror and say, are there any huge gaping holes that would be caused by something happening to either myself or, again, if you're married, a spouse?
Totally.
What do you think about that?
Yeah, so being underinsured or not insured at all is one of those big dominoes that would lead someone to put their hands on the portfolio prematurely and probably at an inopportune time.
Absolutely.
Perhaps there is a need once we do establish something awful has happened in your life, a spouse passes away, a disability comes into the picture, a child gets sick, something that really changes your life circumstances. Now, that's an element to really reviewing your overall financial plan.
Yes.
So I think the sentiment isn't, there is never a good reason to take a look at your portfolio and make changes as your life changes, but not when the markets change. Yes. We know the markets are going to change, whether we love it or hate it or indifferent. Making sure we have that proper insurance in place that matches your needs, not overcovered, but definitely not undercovered. That could be a really good sense of stability that you have if you are properly insured before you're rushed to the portfolio to make that sell that's probably going to bite you in the future. So overall life risk instead of just portfolio risk, I think that's a great way to describe that. Let's talk a little bit more as we come to an end around portfolio risk. So that being another domino, although we think that is being related to buying and selling stuff, perhaps there's some homework we can do ahead of time as a result. How do you think about risk in concert as with being proactive, I guess, and understanding what you're getting yourself into?
Yeah, it's the part of the way I like to think about it is, are you aware of honestly what's on the table from a downside perspective based on the way your money's invested? So looking back historically, history doesn't repeat itself, but it rhymes. We have a general idea of every 1 out of 100 years, a market can do blank. Maybe 5 out of the 100, it can do blank.
Sure.
So just to kind of use some very rough numbers here at risk of oversimplifying things.
Sure.
If your money were to be 100% invested in stocks and a terrible black swan event comes along where you lose 30, 40, 50% of that, are you even aware that that is on the table?
Sure.
We talk to folks sometimes, and I think that there's a sentiment out there that, well, I'm invested in good companies. So because I'm invested in good companies, I'm not actually taking that much risk, even if 100% of your money is in stocks. And okay, well, go back to 2008, and you can go research what were the good companies in 2008 and see what happened to their stock prices back then, right? So good companies aren't necessarily no risk. I would argue that they're the opposite of no risk. And then even, again, I'll use a 2008 example. I know of folks who had their entire investment portfolio in like their company's stock,
right?
Because their company was selling them maybe through an employee stock purchase plan, stock at a discount, and their net worth has just been multiplying like crazy because their company's doing well, and surely their company doesn't have a lot of risk, or why would they be working there and doing so well? And then a black swan comes along, and I mean, a company can lose 90%, 100% of its value quickly. So I think the thought process there is, do you actually know how much risk you're taking, especially to what is the downside based on the way your money's invested? If you're invested in one single company, I would say your downside is 100%. If that company goes under, your investment is worthless. If you're invested in a global mix of stocks, and even during the 2008 stock market crash, you lost significant wealth. And I think the reason that it is important to be aware of that is, first of all, so then when it comes, you're not surprised. You're not thinking the sky is falling and we need to make changes now. Because as we know, and this is where I want to get some thoughts from you, that's probably the worst time to make a change, right? Is when the sky is already falling. What thoughts do you have on that?
Yeah, what's the saying? You don't change horses in the middle of crossing the river. I think there's a ton of truth to that from a market perspective. To some of your points, which I think are fantastic, from a stock perspective, the best investors that I know are the ones that expect downturns. They know they're going to happen. It's not a hope and a prayer of, hopefully this doesn't happen. It's more of a full expectation that there are going to be times where I lose 10, 15, 30 plus percent as you paint that picture. 2008 seems like a distant memory, especially to our generation. Think about 2022. Think about the good companies, the Apples, the Amazons, the Nvidias, the tech companies that our country in particular really seems to stake its value on. Those companies, or the NASDAQ, really an index that's tracking largely technology companies here domestically, was down 30+% at one point in 2022. That's a third of your investment if you just own the high-flying tech companies. Now, we know the story up to this point. We know it's rebounded. You've made your money back and some. You've been rewarded for staying in. But if you've positioned yourself where those dominoes, a handful of them aren't exactly in the position that we've talked about today, having an emergency fund, good insurance coverage, a command over your cash flow, you are selling good companies, let's say, at a steep discount. And you are not giving yourself the option or even the ability to stay in it, rebalance if needed, and keep the train on the tracks. I mean, we know, just seeing the distribution of stock returns, you have to be invested not just to get the average. You're invested to get those above average years that happen more frequently if we look at the last 100 years. So it's not when we are making forecasts for like our planning softwares, and as we expect, money to grow over time, those aren't short-term predictions that we're hoping this is going to be a good quarter. We're literally looking at 100 or so years of data most of the time, especially for the American markets. So I think you're right. I mean, knowing how much risk you're getting yourself into doesn't mean you're invested poorly if you have a bad quarter, a bad year, a bad couple of years.
100%.
Just because your portfolio goes down, this may sound weird, doesn't mean you're doing a poor job, your financial planner's doing a poor job, or that changes are needed to be made. Absolutely. In fact, that can be really tough to make changes during pretty significant market events on both sides, by the way. If you're the person who has cash on the sidelines just waiting for that downturn, if that's just something you have to do, I would caution against that. But taking too much risk during really good periods can be equally as damaging, right? You are setting yourself up for perhaps poor expectations. So taking 100%. Too much risk during downturns and selling out in downturns can be pretty harmful. especially in the short term, to your long-term goals. So I think about it almost in both ways. We tend to highlight, really, don't sell out when things are down, but equally, what may not be a panacea to getting you back to where you need to be is going way overboard and taking way too much risk just to try to catch up. There is no guarantee you will catch up in any certain amount of time. In fact, we've seen periods of decades before certain markets, the United States included, before any recovery actually happens. I think there's a 17-year period here in the United States where your dollar would have been flat. And we've gone from 17 years to 17 months and even 17 days seems like, it's just going to bounce back. Imagine 17 years of your dollar not doing anything and really losing to inflation over that period of time. That's something I think we share responsibility in, helping you make those decisions, helping you become educated on how much risk are you actually taking, what's worst case scenario, what's a reasonable rate of return, how high could the high be is fair to talk through. But I think that's a great domino before you get to actually making a change portfolio-wise. Do you actually understand how much risk you're taking? Fear comes from not knowing what we're getting ourselves into, or not knowing, period. If I think about the things I'm afraid of, it's the things that I don't know. The future being one. No one really knows. So how do we take that fear and make it a little less scary?
And I think maybe one kind of final piece on that is, in terms of how this actually plays out, is generally recency bias overcomes our investment decisions, not ours, but as a collective, maybe society or just an individual investor, where when things are going really well, I want all my chips in. And that means that maybe you are taking more risk than you realize and than you intended to. And then but when some sort of a reset happens, not that we can predict when it is going to happen, but when it does and your money's down 20, 30, 40%, well, then your recency bias takes over and you say, I need to get out. And then you change that. And then as that recovery happens, whether it's in 17 days, 17 months, or 17 years, because you've dialed back, you're missing it on the upside. And then that's when you want to get it all back in again. So that's kind of our own human bias and emotion often takes over in those situations. And that's where I would say a trusted advisor can help you, but just knowing what you're getting yourself into is crucial to not miss out on those periods of upside that you're maybe not exposed enough to, or not being overexposed because you're kind of the greed, honestly, is taking over and you want to get while the getting's good. So it's a tough little situation there.
Even for investors who are thinking they're invested in a more conservative way, but they're still getting market-like returns. I don't know about you, but I've never known Wall Street to give out a free lunch. If you believe that you are conservatively invested, but you are still achieving stock-like returns, you are taking risk somewhere, and it's probably not a compensated risk over the long term. So we've seen certain pockets in the market perform really well this year. Is that actually something that we want to hold in the future? Is the risk and reward trade-off actually fair for us as investors? So really knowing how much risk, but setting appropriate expectations may be the best way to sum it up, no matter where you fall on that risk spectrum. I mean, you naturally think of a more aggressive investor when you're saying, hey, it's not going to be like this forever. But that pendulum swings back to more conservative investors too. If you are not taking as much risk, you have to be okay with less reward. It's not free. There is a trade-off. This is a game. This is an industry of trade-offs. But excellent. Thanks so much for joining me this morning. Thank you for watching. As we see 2025 come to an end, consider these dominoes. And these are just, we are scratching the surface of a handful of conversations we'd like to have with you, or conversations for you to meaningfully think through as we approach a brand new year, which will bring its own set of uncertainties with it. So thank you for watching.